Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, I know that you guys are going over a report today that is very, very timely, and you've brought a guest on. Who'd you bring on today?
Yes, today we have with us Darin Mellott, who's from CBRE. We are going to talk about the highlights from the first quarter investment sales volume. CBRE just put out this pretty great overview of all the activity in the market, going through different property types, markets, buyers, sellers, cross-border flows, a bunch of other things that we're going to touch on. So I brought Darin to come in. So Darin, thank you for coming on the podcast.
Pleasure. Thanks for having me.
So before we get into the meat of that, if you want to just take a second to, introduce yourself to our audience.
Yeah, absolutely. I'm Darin Mellott. I'm the Senior Director of Capital Markets Research at CBRE. So I head up our U.S. capital markets research, but also have a team of analysts around the world that we work as a global team. Capital is global, and that's how we like to operate as a firm as well. And in addition to that, quite involved in writing, other types of white papers and some of the economic thought leadership coming out of the firm. And so, really, really delighted to be here right now in what is a very dynamic time in the markets.
Yeah, so that's a great segue to talking about this report. So according to this, the year over year volume was up 45% for the first quarter. According to your figures, $150.4 billion of total investment volume. Just wanted to start with, if you could, say some of the high level takeaways, from this overall report.
Yeah, well, there are a lot of them, but we'll just start with volume where you started. As you mentioned, it was an extremely strong first quarter, and that's coming off of a record Q4. Q4 of 2021 was especially notable in a historical sense. But, even if you look at the first quarter of this year, it's clear that the market continues to have a lot of momentum, despite the fact that we are seeing a lot more uncertainty in the macro landscape, and anticipate some headwinds to be building as the year goes on. And we can talk a little bit about that. But, generally speaking, extremely healthy quarter, almost across the board. There were some exceptions there. For example, in terms of net buyers and sellers, we saw cross-border investors were, those levels were down a little bit. Not surprising given the strength of the dollar and rising interest rates and the impact that has on hedging costs. But I think what you see is generally a sense of urgency in the market, particularly on the part of sellers trying to get things onto the market as soon as possible. And so, this is sort of what we would have expected in this quarter. We expect Q2 to be also notably strong. And, as I mentioned before, there's probably some headwinds starting to build toward the end of the year that will begin to show up in those numbers.
Interesting. So it's at some level, this is with interest rate concerns, with some of the moves that the Fed might do, that's creating some additional urgency to kind of get deals done now.
Yeah, absolutely. And just to give you an idea of with the type of impact that's having, if you were to look at the pre-pandemic quarterly average, Q1, which is traditionally not the strongest quarter of the year, it was still 14% above the pre-pandemic quarterly average. So this was a historically strong Q1 coming off of a historically strong second half of 21. So there's a lot of momentum. The Fed moves are creating an incentive to move sooner rather than later. And that's why we expect, that sort of brisk activity to continue in the second quarter as well. And in fact, that's what we're hearing from the ground is happening.
And aside from the cross-border piece, which you touched on a little bit, in terms of looking at some of the buyer types, the privates, the institutionals, the REITs and public companies, did anything jump out in terms of their levels of activity? Any surprises or anything notable around certain kinds of investors being particularly active? And the numbers show that some of these groups were net buyers and net sellers. Is that meaningful, or is that, what can we take from some of that?
Yeah, well, I mean, look, if we're just comparing Q1 of 22 to Q1 of 21, in terms of buyer types, cross-border was the only one that was down. And so, we're up quite sharply. Private, which was the single largest buyer type, up 42%. Institutional is up almost 52%. REITs are up almost 83%. But of course, that's a smaller slice of the overall pie. While cross-border was down about just under 19%. So it was very clear that this was a fantastically good quarter that's reflected across buyer types, with the exception of some of that cross-border investment. But that's not surprising either, as I mentioned, just given the strength of the dollar and rising hedging costs.
And in terms of the kind of deals that we're seeing, you do have a breakdown that looks at whether deals were single asset, portfolio, or entity level. It seems like the bulk of the volume is single asset, but pretty substantial numbers still in the other kinds. What does that tell us?
Well, I think there's something really interesting, and I'm glad you brought up some of those differentiations, because when you start looking at the market by type of sale, whether it's entity, portfolio, or single asset, as you mentioned, single asset is the single largest. And if you look at just single asset sales, you can begin to see recovery in investment volumes for office. Mm-hmm. And so, if you're looking at total volumes, it's multifamily, industrial, then office. But if you break it out into that individual asset sales, office actually becomes the number 2 property type. And so I think that's actually quite a positive sign, and an indication of continued recovery in the office market. Now, again, I don't want to overstate anything, but I mean, this is what the data is telling us, is that investors are increasingly more comfortable with office, and that's being reflected in the volumes coming out.
Yeah, actually, interestingly, looking at those single asset year-over-year percentage gains, retail is 1, office is 2, and hotel is 3, which I think it seems would tell us something about where we are vis-a-vis the concerns around the pandemic and reopening, and like the fact that those sectors which during the pandemic were concerns are now like posted such strong numbers. I think seems to say something about how much we have recovered, or people think we could still recover on some of those sectors that got hurt a lot.
Yeah, David, I think that's absolutely right. And we're seeing strength in places that we haven't seen strength, through the pandemic. So, notably retail. Retail had the largest improvement in volumes. This is up 87% year over year. That's extremely notable, and it wouldn't be possible if there was that sort of ongoing level of concern that there was during the pandemic of health restrictions. Getting in the way of improvement in fundamentals.
And then what about from a market perspective? Anything, all the numbers in terms of the year over year were pretty jaw dropping in some of these markets. I'm seeing, a lot of them are triple digit percentage gains. So it's hard to say I mean, so it's like everybody is seeing more activity, but was there anything particularly about some markets that you find would be worth pointing out?
It depends on how you slice and dice it. If you're looking at total volumes, you probably wouldn't be too surprised at what the top markets are, right? You've got New York and LA is number 1 and 2. Dallas is number 3, which is, that's notable as well. Followed by San Francisco and Atlanta, kind of rounding out the top 5 there. And by the way, even though, New York and LA, largest investment markets in the country, to your point about jaw-dropping numbers, I mean, the volumes are up 126% in New York, almost 94% in LA. But where I think it becomes a little bit more interesting is when you start to look in, some of the property types, if you will, where, you can see some of the larger markets coming back in office and quite in favor. And across, hotels, you'll see the largest increases in volume in a lot of touristy areas, thinking Las Vegas, markets in Florida, et cetera. But, across, if you're looking at overall rankings or industrial and multifamily, it becomes clear, and to a lesser extent in retail, that the secondary markets are definitely, proving to be very attractive to investors. And they were among the first to recover coming out of the recession. We expected the recovery to broaden this year into the larger markets, which it has done. But it's pretty remarkable to see some of these growth numbers. It is absolutely jaw dropping, as you mentioned.
And it's interesting in terms of like secondary, tertiary markets. I think historically, find that some buyers would not be comfortable going into those kind of markets, even if they were pretty strong. It's just there's a lot of focus on core markets, top tier markets. Do these numbers indicate that the field of buyers that are considering some of these markets has also expanded in search for yield and search for deals?
Yeah, well, I mean, look, where we see a lot of these strong numbers, it's not entirely surprising. We really don't see much in the way of, huge growth numbers, some outlier of a tertiary market. For the most part, these are well-known secondary, high-performing markets that we see performing well. Now, you could look at hotel investment in Las Vegas, but again, that's a well-established kind of tourist destination and market, right? But if we're looking at office or industrial, for example, I mean, Austin's the number one market for both for volume growth in both office and industrial. That doesn't particularly surprise me, and neither do any of the other secondary markets that we see appearing there. So I think what is becoming clear is that investors, including foreign investors, although the total volumes of foreign investors were down, we do see foreign investors even getting more comfortable going into some of these high-performing secondary markets. So there's kind of this tier 1.5 between the tier 1 and 2 markets that seems to be developing, if you will. And it's clear that investors have been quite confident in the outlook for those markets since really we started coming out of the pandemic-induced recession.
And in terms of the, again, talking about cross-border, one of the other parts of this report looks at which sector they have come in for. And I think historically, I've always thought of cross-border focusing more on maybe office and then getting into some of the other property types. But now it looks like industrial was number one for inbound capital. Multifamily is got a pretty good chunk, even though while office still did get some big volume.
Yeah, that's absolutely right. I mean, traditionally, if you were to look at the share of office, it was always quite large in comparison to the other property types. And there were a few quarters where you could point to some exceptions going on there. But, during the pandemic, the foreign investors saw what everybody else was seeing, and that was increased demand for goods and the impact that was going to have on in industrial and logistics fundamentals. And, we saw industrial become, the most preferred property type. And in fact, that's what it was this last quarter as well. So nothing too terribly surprising there, but it is notable that, starting with the pandemic, the foreign investors made the same type of pivot in terms of property type preferences as a lot of other buyers did as well.
Another piece in here is you've got this breakdown on cap rates that gets into, it's a regular report that you guys put out. Your cap rate report is kind of the, one of the go-tos for just knowing how the industry is doing all year. So you break it down by sub property types. basically, it seems like cap rates are still, like, even with everything going on, and even with some of the interest rate pressure, cap rates are still going down.
Well, look, I would say if you're looking, you got to be careful when looking at certain data points in something like this, because if you look at one data point, you can say, well, this is what it says, and that might be what it is. That said, when we look at the broader market conditions, what we're hearing from the ground and things, I think it's quite safe to say that any the trends of continual cap rate compression, that's over for now. And in fact, as we've moved into the second quarter, and what we're hearing from the field is, there are some cracks beginning to appear in terms of pricing for especially for Class B and C types of product. But generally speaking, we're probably going to start seeing, depending on the property type you're looking at, some mild cap rate expansion. We're probably in the range of 15 to 50 basis points, depending on the location, the property type, et cetera. So, nothing catastrophic, but I think we have to recognize that while we look at the quarterly numbers, conditions changed quite rapidly at the end of the first quarter in particular. And so, the world that we're living in, I think, is of stable cap rates, probably relative stability over the next couple of quarters before we start to see some expansion as the macro environment begins to, I don't want to say entirely deteriorate, but as the macro environment begins to look not quite as favorable as it has over the last 18 months.
Got it. So basically, more like cap rates in Q1 had compressed from a year ago, but where we are right now, that's not the situation. That the cap rates are stabilizing, and I think one of the other parts of that table is looking at the spread between cap rates and treasuries, and I think that's another interesting thing to always look at in terms of where cap rates are sitting versus where treasuries are sitting, and how that's going to also move throughout the year.
Yeah, I think that's exactly a fair characterization. We are definitely in a different place than we have been over the last several quarters.
Are there any other pieces of any other highlights on the report that I haven't asked about that you think would be good to highlight?
I just think it's a really interesting time because if you look across the board in volumes, in pricing, the market is quite strong. But we know that things have changed in terms of both the economic outlook and financial conditions. And that's going to have an impact. And we're just beginning to see the impact of it, but we don't have a lot of data points just yet. But what our models are telling us is that we are going to see a different environment beginning to develop as the year goes on. So nothing doom and gloom, but we're not shy about being clear that there will be increasing headwinds as the year goes on. And, in terms of cap rate compression, that's done for now. And the upward movements in cap rates, in the range of, like I said, 15 to 50 basis points. That's sort of what we expect going forward. So I think, the only thing that's worth emphasizing is just that strong quarter. We're probably in for another strong quarter, but the broader environment is changing, and we'll begin to see that register in these quarterly numbers as the year goes on.
And for folks who want to see the full version of this report, we'll put a link in the show notes so that they can get it there. But in general, what's the best way for folks to keep abreast of the work that you guys are putting out and getting these reports?
Yeah. So, look, feel free to reach out to me anytime. I can try and point you in the right direction, but just go to CBRE.com. You can find our research landing page, and you'll see all of the latest and greatest that we're putting out there. And, you can contact any of us anytime.
Great. Well, thank you so much for your time, giving us the walkthrough, answering my questions. I appreciate it. And hope we can have you back.
It would be my pleasure, David, anytime.
David and Darin, this has been a fantastic podcast. A lot of great information packed into this very, very quickly. So thank you so much for that. And of course, for you, the listener, thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. This makes it really easy to share these podcasts with your colleagues. Again, thanks for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. We'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.